All right, time to talk IT. Sandip Agarwal, fund manager and co-founder at Sowilo Investment Manager, with us this morning. And very good morning to you, Sandip. The first sort of reaction to Infosys was quite negative, so to speak, and the ADR spoke of it. The first cut of commentary, etc., didn't enthuse people at all. If you remove that big refund figure, the numbers look poor. But when I'm looking at what brokerages are saying this morning, they've tempered a bit. What is your sort of overall take on Infosys? Was this because of one deal being renegotiated, a large deal in the BFSI space, which makes them look weak? Is the management commentary giving you enough confidence?
Yeah, hi, good morning, and thanks for having me on the show. Yeah, so, this Indian technology services primarily is a B2B business. So here, 25, 30 clients make most of the revenue, and any change in any program of the top 25 clients or something of that sort, it gives a big hit to the revenue. So and it is actually leadership business where few people are running the big clients and the big deals and the big revenues. So I think what we are seeing in case of Infosys is probably not something which is happening in the industry. I think the industry is in a better shape, and also going forward the industry looks much more exciting and encouraging from the fact that we do have a very strong business interest or business follow-up from what happens in the big techs in the US. And you have seen in last one and a half year how their numbers have turned around and how the stocks have also moved up. And we will have a follow-on revenue from them because we are services players. So if they are making any product or new service, we definitely get benefited from it. The challenge is that what we are seeing in Infosys, in my view, is that there has been a few top leaders who have left the organization in last few months. And I believe that in an IT services firm where business comes from 25, 30 clients, it is very challenging if you lose senior leaders. So that is the way we read it. So I think it is more of an Infosys specific issue rather than an industry issue.
Right. Sandip, what would you do with an Infosys right now? Let's cut through it. There's one camp which says next quarter is looking better in terms of valuations. Like, for example, if you see the Citi note, they're still overweight Infosys, underweight TCS, because they say valuations are relatively decent. What is your sort of one take for our viewers this morning? Is Infosys a buy at dips or a stay away right now?
So, I will put it this way. The large cap Indian IT names generally are poised to give 10-12% return every year. And, whenever those returns are not made for previous some months or some quarters, then, they get bundled up and come in 1 year. That's the way we saw in 2021. But on an average, if they make 40-50% in 1 year, then you can assume that either in the previous 1 or 2 years, they have not made any return, or in the upcoming 1 or 2 years, they will not make return, because their average returns will be 10-12%, because that is the rate at which these businesses grow. They are high dividend distributing businesses. So I would rather say that, Infosys may see today whatever gap down and 1320, 1350 level, but from there, again, it becomes a bet where you can make 12-15% in a year's time in one good quarter, and you get that 15% return. And then, if the returns are going beyond that, they can continue as long as the good numbers are coming. And then at a point, but, on an average, you should not expect more than 12-15% from the likes of TCS, Infosys, HCL and all. And there are obviously leadership issues in some of the big names also, which restrains them from giving even that kind of return.
But Sandip, I have a question. Sandip, sorry, I have a question here based on your answer. Are we effectively saying that the large cap IT stocks, Infosys in particular, becomes a bit of a trading tactical play? That you buy and you make those 10-15%, you get out? Because, as somebody noted, right, if Infosys has said that first half will be stronger than second half, and if they have to meet the quote-unquote guidance, they need to do a very strong 3% CQGR. That might be difficult under the current circumstances. So does it become purely a trading play? Tactically, bahut niche gaya, buy it, sell it 10-12% higher?
Yeah, honestly, that is what it is, because in these large names, you can't make big money, because see the revenue growth, what can you expect even from the likes of TCS? Maybe a 7, 8, 9% kind of growth. And even if you improve the margin, you can say 12, 13% kind of EPS growth. The multiples are already between 25 to 30 times. So whatever you will get as a return will be more or less commensurate with the earnings return. So earnings return, if it is restricted 12, 13%, you can at max make 15, 16%. So that is the story of the large cap. There is no big re-rating and there is no big revenue surprise growth which can come the way it has come in 2021 for the names like Coforge and Mindtree and LTI. That cannot happen in this scale and this size. So I think that is a realistic expectation. So if someone is smart enough to hop in and hop out, it is great. But I think even from investment perspective, 10, 12, 13% annually, if you get, it is a good money, I think.
Well, in this market, it's 10-20% is good money. I mean, I'd simply just buy the index if that was the option. But you talked about Infosys, and TCS for some reason is stacking up better than what INFY has done, at least in terms of commentary. They've said that FY25 will be better than FY24 very categorically. Now, keeping that in mind, and they've not had too many senior level exits either, right? It seems like it's a little more stable as compared to the LTI, Mindtrees or Infosys of the world. Do you think if, given that money is limited at this stage for investors, TCS is probably should be bet the house on and should be a stock to buy if you want to play the IT pack?
So let me put it this way, in case of TCS, they have a very big advantage that they don't have to give quantitative guidance. They always give qualitative guidance. So, they have a lot of more leverage to, to be here and there a little bit. So no one is going to hold them because they are not giving explicit guidance. In case of Infosys, they give explicit guidance. So they have to always be more conservative and more careful. So that is one. Second, I would say that, yes, as you rightly said that, TCS did not have a big exits in recent past, and that definitely helps in this kind of business. So I would say between the two today, if you look at the scenario, it looks like TCS will do better. And particularly when the attrition rates fall, if you see in the past also, whenever attrition rates have fallen sharply, TCS has always been big gainer because the operating leverage for margins from their fall in attrition is much higher than the operating leverage which Infosys has when their attrition falls. So that is very important. And I think that is the reason you saw that 26% margin, and it can actually move up for TCS. So if that happens, then, their earnings growth could be superior to Infosys for at least next 1 year.
Sandip, what about a WIPRO? Very quick response. After TCS is out, Infosys is out, what would you do with a WIPRO this morning?
So in case of WIPRO, only investment argument is it is deep value. Other than that, there is no investment rationale because leadership has never stabilized for a long time now. They have always underperformed, under-delivered. So very less, to comment about it. But only very attractive valuation. This 420, 440 level is where they become extremely attractive given the high dividend yield and all. So probably that is the only rationale.
New boss will speak today at WIPRO, or we'll at least hear from him on his outlook. Thank you so much for that, Sandip. Just one